I'd like to address the next question to Charles Goodhart. Viewing or designing financial institutions as being too big to fail potentially distorts the role of market discipline by diminishing the incentives for creative and productive activity and by encouraging excessive risk-taking. How can we design financial regulation to avoid such adverse consequences, and how should these regulations feed back on macroeconomic conditions?
Thank you. I don't have slides. There was a phrase that was used in rather Republican quarters about gun control in America, which went something like, guns don't kill people, it's the people who fire them who do. And in much the same kind of light, I would argue that it's not banks that make mistakes, it's the bank managers who make mistakes. So that what really matters is the incentives of the managers, the incentives of the people who take the decisions, rather than the question of the actual formality of what actually happens to the institutions. Now, if we go back to the incentives of managers, the past was actually so, at any rate in this country, when we shifted from unlimited liability to limited liability, because we didn't, with unlimited liability, we couldn't get enough capital into banks to be able to finance the big industrial enterprises that were growing up at the end of the 19th century. So in order to compete with the European, or the continental rather, universal banks, we moved on to limited liability. It was always reckoned that that was going to increase risk-taking enormously, and the suggestion at that time was that transparency would provide the discipline. There's a wonderful passage in George Ray's book, The Country Banker, where in line with the limited liability, all banks were required to have their accounts audited once a year. And it goes something like this. The crises of the future will be a mere pittance compared with the crises of the past. Now that bank auditors are required to cast their steely eye once a year over bank accounts, never again will banks and bankers be able to cast a pall of obscurity over their misdoings. So on he went. And you know what happened. So transparency and accountability will get you so far, but not all that far. So you've got to have other things as well. Well, how about regulating behavior, the sort of Basel III and all the rest of it? Well, that's problematical. Partly because the regulator will never keep up with the banker, in part because the regulator pays peanuts compared to the banker, and they're just not on the same sort of level. There's also, if you shove in your regulations, which take forever to set up, there's what's known, I believe, as something called the Lucas critique, which is better known in this country as Goodhart's law. Which effectively says that if you have any statistical regularity which your authorities then try to use for control purposes, that statistical regularity will break down. What's more, in fact, regulation tends to be wildly pro-cyclical and is showing its teeth in that form precisely now. Because whenever you have a crisis, what will happen will be the regulators say, that must never happen again. So they shove on every regulation they can reasonably think of, and the banking system, therefore, is forced into even greater deleverage than would happen before. Now, what then happens is that things calm down and everything seems to be all right, and since regulation stops people doing what they otherwise would want to do, you see the losses, the costs of regulation rather than the benefits, so that regulation naturally gets eroded, until the next crisis hits at the point where a regulation has been eroded. And I can predict that the next regulation, the next crisis, financial crisis, will occur in about 20 years' time, at which point Basel III and all of that will be strictly eroded. There are those who say that the right way to go about it is to regulate structure. And you have the Vickers report, Kotlakoff's mutual banking, narrow banking, and all the rest of it. And that doesn't work either, for lots of reasons, like boundary. What the Vickers Commission, the ICB, completely forgets is that the main cause of the crisis in this country wasn't anything to do with proprietary trading or anything like that. It was to do to simple bad banking on housing and property, and usually is. I have lived through 3 financial crises in this country, all relating to basic, simple banking, which the ICB would allow. And if you have people like Sir Fred Goodwin, who did have a KBE, which is one up. The order, Lars, is MBE, OBE, CBE, and KBE, and these are provided in this country as an alternative to pay. which is, of course, their purpose. And it works jolly well. And people go into the civil service and get to the high levels because although they don't get paid very well, they know that their wife is going to become Lady Smithers or whatever. Now, so regulating behavior won't work, regulating structure won't work, or at least you've got to do it a bit, but it doesn't work perfectly. So what would I go for? Well, I think you've got to go back to incentives for managers, and I would like to see the capital ratios adjusted. So the capital ratios, when they were introduced with the Basel I in 1987, 1988, nobody ever asked, what is the theoretical analytical basis for this? It was all done purely pragmatically. It was done on the basis of what was the highest number that the worst off large country could apply without running into significant difficulties. Now, what I think we need to do is to have 2 ratios, a bottom ratio, at which point the bank is so dangerous that it actually needs to be taken into temporary public ownership, and a very much higher ratio, much higher, than may be capable of filled by high trigger COCOs, which would be, if you like, fully satisfactory, with a ladder of sanctions between the two. And one of the sanctions would be that the amount of payout, both in the form of bonuses and dividends and buybacks, would be restricted as you got down from the top ratio down towards the lower ratio. Now, there are lots of problems with that. There are lots of problems with all of it. And the likelihood is that we're not going to do terribly well. We never have done terribly well in the past. And the regulation will go on being its dear old pro-cyclical self, which is what is happening at the moment, and which is not leading or not helping to bring about the recovery in Europe that we all want. Moving from a core tier equity of somewhere under 2% of risk-weighted assets to one of 9% by June this year is not exactly what you want if you want to stop your banks deleveraging and starting lending to companies throughout Europe.
Good. Francisco?
Yeah, well, I know comparatively little about the regulatory discourse, so to be able to comment on the specifics, I would just say that from our perspective, there is a big I think there is a big attempt to discover where the regulator wants ultimately the risk to reside, and that to our eyes is not clear. We know they don't want it in the banks. Whether they're comfortable in having it in the shadow banking system is another matter, and what format that configuration will eventually converge to, and what in turn interactions with the banking system will be the new steady state is also unclear. To my knowledge, the SB regulation is still in the infancy, collecting data process, and so I fear that a lot of push will be given on the banks. And my only observation here is, whereas in the UK, the system looks, to my eyes, slimmer, now with only Barclays being in private hands and the rest being
HSBC,
but
Standard and Chartered.
If they stay, they keep on.
HSBC is, I think, the third largest bank, doing extremely well.
I know, but they threaten to leave this country every other week. So I think we'll see what the new steady state will be there. But my holistic picture is that the UK seems to be better equipped to manage this transition. And whereas in the US we have a well-developed capital market which can take some place in adjusting to the transition, I fear that Europe is very much behind. When I look at the French banks in particular, and somebody talks about implementing Vickers, I cannot help but thinking that this is the ultimate credit crunch looming. So that is an aspect that I think we in marketplaces are very sensitive to.
John? I always have something to add. And I'm always the wild one on the far end of the table. Charles said something very interesting and I think revealing, which I've noticed as well, the pro-cyclical regulation. We're in this strange place in the U.S. where the Federal Reserve is trying to shove money down the system like a goose that they're feeding pate, with 0% interest rates and massive sort of QE. That's on the one part of the Federal Reserve. The other part, the part that oversees the banking system, is sort of loudly saying, don't you dare lend anything to anyone. So we're in this crazy situation of 3% mortgages that nobody can qualify for because the right hand and the left hand are fighting each other. That's a deep insight about regulation. I don't think Charles went far enough on the too big to fail problem, because and Lars asked it, so I get to say a few things about it. That is really the core. So we've been around this circle a few times, getting worse and worse and worse. Our basic system for addressing runs is to bail out creditors, but that leads to moral hazard. Banks take too much risk, so we try to regulate them against taking too much risks, and then we bail them out again or resolve them or whatever afterwards. And this has just gotten bigger and bigger and bigger to the point now the U.S. has basically these 6 huge banks that everybody knows are too big to fail. And there's sort of this charade of we're going to regulate them and stop them, and everybody knows that lending to them is perfectly safe. With that, the hair in my neck went up when Charles said temporary public ownership. So that's the resolve part. I mean, that means basically nobody who lends to these banks don't get lent out. Their creditors get bailed out, and that means lending to these things is always going to be a perfectly safe game, so long as you have the appropriate politician's phone number in your pocket. Equity, well, I stop at 9%. How about 30%? You guys remember the Modigliani-Miller theorem? It says banks could operate with huge amounts of equity. No, it's not perfectly true, but it's not completely untrue. Why are banks so reluctant to operate with the kind of equity that Google and Apple find perfectly happy? They have no debt whatsoever. Well, because we subsidize it. There's the tax shield to debt. There's the bank. Being a bank means you get to borrow at 0. I can see Charles going nuts here. You can borrow at 0, where you and me have to borrow it at 5%. At least let's get rid of the elephant in the room, which is the massive subsidies towards debt as well. And equity, yeah, okay, they might deleverage, but why are they allowed to pay dividends as long as their equity is so low? Because then every time a crisis comes, we must recapitalize the banks, which means watch your wallet, because it means at government expense, not like we go look for new investors. Yet they're allowed to pay out dividends. I mean, if you need to recapitalize them afterwards, more capital now. So I agree with capital, but let's keep going, and perhaps we could have a financial system that wasn't too big to fail.
I'm going to give the last word on this to Charles.
If you'd like it.
Go ahead.
No, I'd like to give you the last word if you would.
Right. I think that the big banks that we have, and most countries, have about 4 major banks in an oligopoly doing most of their banking. Why, I don't know. The sort of the underlying industrial structure of banking, and what means that virtually every country ends up with about 3 or 4 really big banks, I don't know. But I think that these things are too interconnected to liquidate. And if you mean by allowing them to fail, liquidating them, I think that would be a total disaster. I'm all in favor of not having the taxpayer taking them over, but I think that means that you need to think much more in terms of high trigger COCOs, bail-inable bonds, and stopping the management in their tracks well before the banks actually get down to liquidation. I think that if you mean that we mustn't have too big to fail, that we've got to allow another Lehman's to go under, God forbid, we can't do that. And I think that allowing any of the big 8 that you were talking about actually to close their doors would be a total disaster. So I think that those people who say we must cure too big to fail really must redefine exactly what they mean by fail. If they mean liquidate, I'm not with them. If they mean somebody else other than the taxpayer takes up the burden and pays, then I'm with them. But I expect them to spell out in much more detail who takes up the burden, at exactly what point, and at which trigger.